September, the month that sends chills down investors' spines. But why? What if I told you that this month could potentially wipe out all your summer gains? In the next few minutes, I'll reveal why September is often called the worst month for stocks, and more importantly, how you can protect your portfolio. We'll dive into the historical data, the current market dynamics, and strategies that could save your investments. Now, you might be wondering how I've uncovered all this crucial information. It's not just years of experience as a trader. It's also about having the right tools and knowledge, and perhaps having my golden retriever, Winston, here to help sniff things out. Speaking of which, I'm also thrilled to share that our teaching portfolio is up over 80% this year. That's a $24,000 gain on a small 30K portfolio. Fancy learning our 3-step system for free? I'm hosting a beginner trading challenge next week where I'll teach you our entire system completely free of charge. All you got to do is go to felixprehn.org/challenge and join the hopefully soon to be 1 million people we're helping to get to financial freedom, because that's the goal. But first, let's unravel the mystery of the September effect. Historically, September has been the worst month for stocks, but don't just take my word for it. Let's look at the numbers. Since 1950, the S&P 500 has averaged a decline of about 0.5% in September. It's the only month with a negative average return over this period. The Nasdaq doesn't fare much better. Over the past decade, it's closed in the red 8 out of 10 times in September. Extended to 20 years, and we're looking at 10 out of 20 negative Septembers. Now, you might be wondering, why September? Well, there are a few theories. One, end of summer. Investors returning from their holidays are reassessing their portfolios. Maybe they spend a little bit too much money in the south of France and they're trimming their investments. Number two, mutual fund tax selling, and this is a big deal. Funds often sell losing positions before their fiscal year ends, and a lot of mutual funds have their fiscal year ending just after September. And then we look at Q3 earnings. Investors get cautious ahead of the third quarter earnings reports and might trim their positions, kind of trying to figure out what's about to happen here. Now, you might have noticed the numbers. 10 out of 20 times over the last 20 years. Felix, that's 50-50. Well, if I tell you that 2 times the Nasdaq bucked this trend in the last 20 years are 2003 and 2008, both years following major economic crises. So the million-dollar question here is, will 2024 follow suit? Are we in for another classic September slump? We've established the historical pattern here, so let's delve into the unique factors at play this September of 2024. First, we're coming off an August rally that's been driven by several temporary factors. And these include, first, we've seen record company buybacks. Companies have been purchasing their own shares at an unprecedented rate. However, this is set to conclude on the 6th of September due to the upcoming earnings season blackout window. You might want to write that date down, 6th of September. 2, pension funds have been quite busy. They've been selling bonds and scooping up about 40 billion in stocks by the end of this August. And this rebalancing act is a quarterly occurrence, but it is going to be complete by the beginning of September. And then we got algorithmic funds, or algos as we call them, or CTAs. And they've been significant buyers too. They've pumped about 80 billion into the stock market before the end of August. But their buying power is expected to decrease substantially into September, maybe buying only 10 billion over the coming month versus the 80 billion in the last week of August. And then we've had August's low liquidity environment. It has made it easier to drive up the rally. Just think about it. If there are 2 buyers and only 1 seller, well, both buyers have to buy from the same seller, and therefore prices are going to get more elevated. There's sort of a bidding frenzy. That's the way the market works. All of these factors are exhausting the momentum of this rally as we enter into September. And it begs the question, who is left to buy? This situation aligns perfectly with the historical September weakness we discussed earlier. It's as if the market is setting the stage for a classic September effect performance. Now let's also take a look into the minds of investors as we approach September. It's rather fascinating. We observe a peculiar phenomenon in the options market. there has been an uptick in the demand for put options. You might not know what that means, but for anyone unfamiliar with put options, they're essentially an insurance policy against stock price declines. So the surge in put options suggests that many investors are bracing themselves for the expected September dip. And we can also see that those very insurance buyers are willing to pay a premium for downside protection. Another indicator that things might look a little dodgy going into December. So one might argue that this bearish sentiment is simply a self-fulfilling prophecy. Investors, aware of the historical September weakness, position themselves defensively, which in turn could precipitate the very decline they're trying to protect against. However, it's crucial to note that market sentiment isn't always an accurate predictor of market direction. Sometimes, when everyone expects a particular outcome, the market has a cheeky habit of doing the opposite. Now, I know what you're thinking, Felix, surely there must be some positive catalyst here. And of course, there are a couple of potential bright spots here. First, NVIDIA earnings reports on August 28th. Hasn't come out yet by the time I'm recording this. And this AI chip maker has been, well, the market darling, and strong results could ignite a tech sector rally. We're expecting about 28 billion revenue. That's up about 100% from a year ago. And if NVIDIA surpasses these expectations, it could provide a significant boost to market sentiment. And then two, after Powell's Jackson Hole speech, the Fed first rate cut is almost certainly going to be on September 18th, although this is likely already priced into the market. Now, a bigger rate cut than expected would be positive, but a quarter cut is probably not going to do all that much. But there is another potential positive. Oil prices. They've been relatively stable recently. Crude's been hovering around $75 a barrel. And this stability, if this stability continues, or we see a decline if the situation in the Middle East kind of improves a little bit, it could ease inflation concerns and once again support consumer spending. But the real question is, will these positive factors be enough to overcome the historical trend in the exhaustion of buying power from major market participants? So let's dissect how different sectors might fare in this potentially rather turbulent September. First up, you've got tech. Despite the broader market concerns, this sector might just weather the storm quite well. Two factors are at play here. One, the potential for lower interest rates, which typically benefits growth stocks. And then two, positive sentiment from NVIDIA's earnings, if they are going to be amazing, could spill over to the entire tech sector. However, do keep in mind that tech stocks have had a stellar run this year. The Nasdaq 100 is up 25% year to date, and there is a risk that any disappointment could lead to, well, profit taking. Now on to financial stocks. It's a sector I like quite a lot at the moment. And, well, on the one hand, lower rates could pressure net interest margins. On the other hand, if market optimism prevails, financials could benefit from increased trading activity and more investment banking deals. And that's kind of what I'm betting my horse on. Year to date, the financial sector is up about 15%. So if you keep an eye on the yield curve, if that steepens, it could further impact the financial sector. Lastly, let's consider some defensive sectors: utilities, consumer staples, and healthcare. All three have done very, very well in the last few months. Typically, these are kind of your steady eddies of the market, right? The shelter during the storm. However, if risk appetite increases due to rate cuts, these sectors might start to lag behind a little bit. Year to date, utilities are up 20%. Now, there's a crucial point to remember, though. Sector rotation can happen very, very quickly. What's out of favor today could be tomorrow's darling, and that's why diversification, in my humble opinion, remains key, even in bull run times. So with these sector dynamics in mind, let's explore some strategies to navigate this September. So let's give you three strategies here. I call them the traffic light strategies. The red light is your cautionary strategy. Consider trimming your bullish positions early in the month. If you've enjoyed substantial gains of the summer, it might be prudent to take some profits off the table or at least set some stop losses or trailing stop losses. Your yellow light strategy is to prepare to buy the dip for your long-term portfolio. Remember, market corrections present an excellent buying opportunities for patient investors. Keep a watch list of high-quality stocks you'd like to own at lower prices, so you're ready. And then the green light is focus on high-quality names. These are companies with strong balance sheets, consistent cash flow, and a competitive edge. They tend to weather economic storms better than their peer. So what should you be monitoring in the next couple of weeks? Well, one, you could obviously just join in and watch me pre-market live, and I'll do it for you. But one, you want to look at the bond market and the yield curve. Keep a close eye on the 10-year Treasury yield. If that starts to rise significantly, it could put pressure on stock valuations, especially the tech sector. Number two, watch what the Fed's going to say. Any shift in the Fed's narrative from this love letter to the stock market last Friday to something a little bit more conservative could have a significant impact on market sentiment. And then number three, there's certain economic indicators we want to watch out for. Key data points are the jobs report and inflation figures, and maybe some of the consumer sentiment thingies. And I run through those every week if you just watch me pre-market. And why do we do that? Because they can give us some insight into the health of the economy and therefore influence which sector is going to move in what direction, which takes me to number four, which is sector rotation. Monitor which sectors are outperforming or underperforming. And I showed some of my coaching students exactly how to do that last night. We did a live trading session together. It's actually very easy. You can use an ETF to track it. And it gives you clues about where's the smart money flowing. And then number five, open the VIX chart every once in a while. It's called the fear index. A rising VIX could indicate increasing market uncertainty. And most people don't look at that. As options traders look at it every day because it's such an insightful piece of information. But remember, the key to successful investing isn't actually predicting the future. It's about being prepared for every scenario and having a strategy that actually works that helps to make you money. So you don't need to watch every bit of news or information out there. You just need to have a good strategy that gets you through choppy market waters. I like choppy. I like markets that fall. It's actually easier to make money. So if you want to understand how we do that, come and join me on Tuesday. FelixPrehn.org/challenge, and I'll give you my strategy for free and show you how we're up 80% this year. I'll show you the actual trades and everything else. So my September game plan, stay a bit cautious, don't panic, but yes, maybe take some profits off the table. Keep some powder dry. If there is a dip, we'll enjoy it. Nvidia might mean that there is no dip if they really beat it out of the park. And I will continue to focus on high quality stocks, strong fundamentals, and just take advantage of everything that happens here. And if you see every day and every week as a learning opportunity where you get better, where you get smarter, where you're in a better position because your skills are improving, so your money is working harder for you and smarter for you, so you don't have to, then you're very much on the right track. If you want to start to get on that track, join me at FelixPrehn.org/challenge next week, free of charge for 2 hours. And until next time. This is Felix, wishing you profitable investing in a fantastic September ahead. The chance of a hard landing just doubled in the last 5 days. By the end of this video, you will know how a hard landing recession would impact your favorite tech stocks, including Tesla, Palantir, SoFi, and PayPal.